Exchange rates, what they are, how they work, why they fluctuate. Exchange rates are a fundamental concept in Forex trading. They determine the value of one currency concerning another currency and play a crucial role in international trade, investment, and financial markets. Here's a more detailed explanation of exchange rates, how they work, and why they fluctuate. What are exchange rates? Exchange rates, simply put, are the prices at which one currency can be exchanged for another currency. They represent the relative value of different currencies in the foreign exchange market. Exchange rates are usually expressed as pairs, with one currency listed as the base currency and the other as the quote currency. For example, in the EUR-USD currency pair, the euro is the base currency and the US dollar is the quote currency. How do exchange rates work? Exchange rates are determined by the forces of supply and demand in the Forex market. Here's a simplified breakdown of how they work. 1. Market participants. Various participants, such as banks, financial institutions, corporations, governments, and individual traders, engage in buying and selling currencies for different purposes, including trade, investment, and speculation. 2. Supply and demand. Like any other financial market, exchange rates are influenced by supply and demand. If more people want to buy a particular currency, increased demand, its value tends to rise. Conversely, if more people want to sell a currency, increased supply, its value tends to fall. 3. Economic factors. A nation's economic health, including factors like interest rates, inflation, employment, and economic growth, significantly affects its currency's value. Currencies of countries with strong economies often appreciate compared to those with weaker economies. 4. Interest rates. Differences in interest rates between two countries can impact exchange rates. Higher interest rates in one country may attract foreign capital, increasing the demand for that country's currency. 5. Central bank policies. Central banks can influence exchange rates by implementing policies like changing interest rates or engaging in currency interventions to stabilize their currency's value. 6. Political and geopolitical events. Political stability, government policies, trade relations, and geopolitical events can create uncertainty and affect exchange rates. For example, elections, trade disputes, and international conflicts can lead to fluctuations. 7. Market sentiment. Traders' perceptions and sentiments can also influence exchange rates. Positive news about a country's economic prospects can attract more buyers. Why do exchange rates fluctuate? Exchange rates are not fixed. They fluctuate continuously. Several factors contribute to these fluctuations. 1. Market speculation. Traders and investors speculate on currency price movements. They buy or sell currencies based on their expectations of future exchange rate changes. 2. News and events. Economic data releases, political developments, and geopolitical events can trigger sudden and significant movements in exchange rates. For example, an unexpected change in interest rates or a political crisis can lead to rapid currency value changes. 3. Global trade. Currency values are influenced by international trade. Changes in a country's trade balance, exports, and imports can impact its currency's value. 4. Interest rate. Differentials. Differences in interest rates between countries can attract or deter foreign investments, leading to exchange rate movements. 5. Market sentiment. Trader. Sentiment and market psychology play a role. If many traders believe a currency is undervalued, they may buy it, leading to price appreciation. 6. Interventions. Sometimes, central banks or governments may intervene in the foreign exchange market to stabilize their currency's value. This can impact exchange rates. 7. Hedging and speculation. Large corporations and financial institutions engage in forex markets to hedge their currency risk or speculate on price movements, contributing to market fluctuations. In summary, exchange rates are the prices at which one currency can be exchanged for another, and they are determined by supply and demand forces influenced by various economic, political, and market factors. These rates are continually changing, reflecting the dynamic nature of the global economy and financial markets. Traders and investors in the forex market aim to profit from these fluctuations by accurately predicting future exchange rate movements.